Home Depot reaffirmed the full-year margin band, but that outlook is quietly leaning on tariff refunds showing up to offset rising costs. In this video, I'll grade the report, then walk you through how I'd trade the wheel on it. Nothing here is financial advice. Home Depot gets graded and traded. All right, on the top line, revenue came in about 1% above what analysts expected. That's a small beat on the surface, but for a company this size, adding an extra $500 million in sales versus the estimate is real money and shows the business held up better than Wall Street was modeling. On the earnings side, they came in about 4% above what analysts expected. EPS is what Wall Street grades a company on, and even a modest beat here gets attention because it tells you the business is converting sales into actual profit at a rate the analysts underestimated. So on the beat itself, this earns a C. A 1% revenue beat and a 4% EPS beat is a solid, clean print, but it's not the kind of blowout number that changes how anyone thinks about the stock. And on consistency, this earns a B. Home Depot has a long track record of showing up in the ballpark of estimates quarter after quarter, and this print keeps that streak intact without any big surprises either way. Let's talk about the positives from the report. Total sales grew almost 6% year over year to about $48 billion, and same-store sales were up 1.7%. That's a real reacceleration from last year when comps were basically flat, which tells you the business is starting to find its footing again. The clean earnings number grew about 5% to $4.92 per share, and operating income was up over 4%. So even with costs climbing, they still turned that top-line growth into more profit, which is the whole game for a mature retailer. Cash from operations over the first 6 months jumped to $11.4 billion, up from about $9 billion last year. That's a huge improvement, and it's the cash that funds the dividend, pays down debt, and gives management flexibility to keep investing in the business. Management reaffirmed the entire full-year outlook, sales, margins, EPS, all of it. They're telling investors that after this beat, the plan they laid out at the start of the year is still on track, and the second half should land where they said it would. They paid off $3 billion of long-term debt in the first half, which is more than double what they paid down a year ago, and total shareholder equity rebuilt from about $11 billion to over $16 billion. Quietly, the balance sheet is getting a lot stronger. So on profitability, this earns a B. They're growing earnings and generating serious cash, but selling, general, and administrative expenses costs are climbing faster than revenue, which is squeezing margins even in a beat quarter. Now let's talk about the negatives from the report. Comparable customer transactions dropped 1% year over year. All the sales growth this quarter came from customers spending more per visit, not more customers walking through the door. That's a fragile mix, because if the size of each ticket normalizes, there's no traffic growth underneath to catch the business. Operating margin actually shrank a little, from 14.5% to 14.3%, and their operating expenses grew 8.5%, while sales only grew about 6%. When your costs are climbing faster than your revenue, even a good quarter starts feeling tight, and that's the story here. Inventories grew about 8% to almost $27 billion, which is faster than sales grew. That means they're building up more product on the shelves than they're selling through, and if the back half of the year comes in soft, they could end up marking that inventory down to move it. Here's the one I keep coming back to. The reaffirmed margin outlook is leaning on tariff refunds, showing up to offset rising fuel, energy, and product costs. If those refunds don't fully materialize the way management is expecting, the margin band gets squeezed even if sales hit their numbers. Total debt is still sitting around $53 billion, and they're guiding to about $2.3 billion in interest expense this year. That's the leftover leverage from the SRS acquisition, and it means the balance sheet is still sensitive to what rates do from here. On guidance, this lands at a B-. They reaffirmed the full-year framework across sales, margins, and EPS, which is a real positive. But the fact that the margin band depends on tariff refunds coming through means the outlook has an execution risk baked into it. And on red flags, I'm at a C+. The transaction decline, the inventory build, and the tariff refund dependence are all things I can't just dismiss, even in a quarter where the headline numbers came in fine. Putting it all together, this was a clean beat and reaffirm quarter from a high-quality operator. The business is still leaning on ticket growth rather than traffic, and the reaffirmed margins depend on tariff refunds showing up. But the cash flow, debt paydown, and full-year framework all point in the right direction. Nothing here changes the 12-month story either way. I'm giving this print a B-. To start trading the wheel on Home Depot, we first sell a cash-secured put, which means we get paid a premium upfront to agree to buy 100 shares per contract at a price we pick. We choose the strike price, which is the price we are willing to buy shares at below the current price, and our broker sets aside the cash to cover the purchase. At expiration, two things can happen. Either the put expires worthless, we keep the premium, and we can sell a new put, or the price falls below our strike price and we get assigned, meaning we are required to buy 100 shares of Home Depot at our strike price. Now, let's talk about why selling cash-secured puts on Home Depot makes sense here. Management reaffirmed their full-year 2026 guidance right through this print, and that matters a lot when I'm picking a strike. Reaffirmed guidance means the floor under the stock is a real floor, not a moving target, so the odds of some ugly gap down between now and my expiration are lower than they'd otherwise be. Second quarter comparable sales reaccelerated to positive 1.7%, which is a clean bounce off the softer first quarter. That reacceleration tells me the underlying business is stabilizing, not deteriorating, and if I do end up getting assigned on a pullback, I'm landing on shares of a company where the trend is actually turning the right way. First half operating cash flow came in at $11.4 billion. That's the piece that lets me sleep at night if the stock dips through my strike and I take assignment. A business generating that kind of cash can keep paying its dividend, keep paying down debt, and support the share price over time. So owning it at a discount from selling puts is a genuinely fine outcome. The stock trades tied to housing data and tariff headlines, and both of those can whip the shares around on any given week. So instead of chasing shares at the top of the range, I'd rather sit back, sell puts into weakness, and let the volatility come to me. Patience is the edge here. So here's how I'd structure the trade. I'd sell puts about 10 to 15% below the current price out in that 30 to 45 day window, and I'd wait for a 5 to 8% pullback before actually pulling the trigger. That gives me a strike I'd genuinely be happy to own shares at, enough time to collect real premium, and an entry that isn't chasing the top. Now that we own 100 shares of Home Depot, we can sell a covered call, which means we get paid a premium upfront to agree to sell 100 shares per contract at a higher price we pick. We choose a strike price above our cost basis, which is what we paid for the shares, and the premium hits our account immediately and is ours to keep no matter what happens. At expiration, two things can happen. Either the covered call expires worthless, we keep the premium, and we can sell a new covered call. Or the price runs above our strike and we get our shares called away, meaning we are required to sell 100 shares at our strike price. We collect any appreciation up to our strike price on top of the premium we already kept. From there, we are back to selling cash-secured puts on Home Depot to start the wheel over again. Now, let's talk about why selling covered calls on Home Depot makes sense here. Comparable sales reaccelerated to positive 1.7% this quarter, and that matters a lot for how I think about strike selection. When comps are inflecting up like this, capping upside too tight is a mistake because a print like this can carry the stock for weeks. I want premium, but I want room to run. Guidance reaffirmed for the year, which meaningfully reduces the odds of a nasty downside gap between now and the next earnings date. That's the whole reason I feel comfortable writing calls at all here. The forward setup is clean enough that I'm not worried about a surprise warning knocking 20% off my shares before I can react. $3.04 billion of debt paid down in the first half of the year tells me the ownership case is intact. This is a business generating real cash and using it responsibly. So I'm not looking for a reason to let shares get called away cheaply. If my strikes get tested, I'd rather roll them up and out than lose the underlying. Rolling up and out is exactly the playbook the analysis calls for here. If I've already got calls sold and they're getting close to the money, I'd rather close them early and rewrite further out in time and higher in strike. I keep collecting premium, I keep my shares, and I don't get forced into a taxable sale on a name where the fundamentals just reaccelerated. So here's how I'd structure the trade. I'd sell my calls 15 to 20% above my cost basis, using expirations 30 to 45 days out, and I'd wait for an 8 to 10% rally before writing them so I'm selling into strength instead of weakness. Bottom line, this print earns a B- from me. Home Depot did what a high-quality operator is supposed to do, a solid beat, a reaffirmed full year, and quietly improving the balance sheet in the background, even with traffic still soft. So that's the wheel play on this one. If I'm looking to get in, I'm selling cash-secured puts to collect premium while I wait for a price I'd genuinely be happy owning shares at. And if I already own the stock, I'm selling covered calls above where I bought in to keep pulling income out of the position until the shares eventually get called away. Thanks for watching, and I'll see you on the next one.